Real estate investing is a great way to make a lot of money fast. It's also a great way to create a ton of wealth. Shoot, it's it's the best investing tool ever, and it's a great way to make money. But another huge benefit of real estate investing that most people don't talk about, usually because it's boring, is the tax benefits of real estate investing. So in this video, I'm going to talk about the 3 main ways that you can save money on taxes investing in real estate. I'm going to try to keep it fun as well. Let's go.
The content in this video is for information purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice.
So let's talk about 3 simple, easy ways that you can save money on taxes investing in real estate. And number 3 is by far the most powerful and my favorite. It saved me a couple $100,000 in taxes. Spoiler alert. Tax laws are always changing. Sometimes they benefit some group of people and sometimes they don't benefit other groups of people. However, I'm confident that real estate investing is always a great way to save money on taxes. There's probably enough politicians that are tied to real estate that they're going to always want to create some types of loopholes and some types of ways to save money on taxes. First main way to save money on taxes is depreciation. I'm going to do a simple depreciation example on the whiteboard here in a minute, but before, let's kind of talk about what depreciation is. Depreciation is basically taking a percentage of a property's value and dividing that over time and taking that off your taxes. So you get a percentage of what the property's worth, and that directly comes off of the income that that property creates. So it's just a great way to offset some of the gains of a rental property by depreciating it out. Now, depreciation does just kind of push off taxes later, but that's kind of the goal of taxes and avoiding paying taxes right now. Eventually, you're going to have to pay taxes on things, but if you can push them off, and pay them at a later date, there's always going to be more options and more avenues that pop up down the line that you'll be able to take advantage of. And the goal is to make more money every single year. So if you're pushing off taxes now and in 10 years you're going to pay them, but you're making a lot more money, it's a lot easier to swallow at that point.
All right, so I'm up here on the whiteboard wanting to explain depreciation to you and how it works for houses. Let's go over a simple example. So let's say you have this $200,000 house. You are allowed to depreciate the house, but not the land. So you have to back out the land. It's usually pretty simple. Most people do 90%. So you take 200,000 times 90%, and that gives you $180,000 worth of actual real estate, not the land, that you can depreciate. So you take that 180,000 and divide it by 27.5. Why 27.5? I don't know. That's just the number that is used. It's standard. It's the only number you can use that allows you to depreciate over 27.5 years. I guess they got together and figured that's how much time it takes to depreciate real estate. So do that math, and that gives you 65.45, assuming my iPhone calculator works, worth of depreciation in each year, over 27.5 years. So that's how much you can write off of your rental properties every single year. To take that one step further, divide that by 12 months, which gives you $545 a month that you can depreciate. Pretty much every single one of my rental properties cash flows $200 to $400 a month, meaning the cash flow that I make, the profit that I make on my rental properties is less than the amount I'm able to depreciate. So that $200, $300, $400 a month I'm making on each rental property gets taken out by the depreciation, meaning I don't have to pay any taxes on that income. Before I move on and before I erase that, make sure to hit that like button. I'd really appreciate it. It helps out this channel.
Another type of depreciation you can do is you can depreciate your vehicle. So if you're using your vehicle to invest in real estate and you have an LLC and the LLC owns that vehicle, you can depreciate it. Depending on what the current tax laws are, sometimes you can depreciate the entire amount of a vehicle. So if I buy a car that I use for my real estate investing business and it's a $50,000 car, if I do it right, play my cards right and follow the rules, I can depreciate that entire $50,000, meaning if I make $100,000, I can take $50,000 off of that and only pay taxes on $50,000 instead of the $100,000 because I depreciated that entire vehicle. So make sure your business is set up that way and you bought the vehicle the right way. There's just a lot of different ways to depreciate things that you're using for real estate or depreciate the actual real estate to save money on taxes. Write-offs are another great way to lower your taxable income. Write-offs are basically just taking something that you're using in your business and writing that off your taxes and lowering your taxable amount. Some examples of write-offs are your mortgage interest. The interest that you're paying on your mortgage on your rental properties, you can take that off your taxes. Another one is real estate taxes. You can take the taxes that you're paying to own the property tax that you're paying to own that real estate, and you can take that directly off of your income for that following year. There are a lot of different things that you can write off, but basically they're money you're spending anyway, and you can take that money that you're spending anyway and make sure to get that written off or taken off your income. I think it's best to have an LLC set up for legal purposes and protection purposes, but also if you have an LLC, you should have a separate bank account for that, and then all your expenses, then your business will go into that LLC. Therefore, it'll be easy to track, so you know you can go through your bank statements or have your bookkeeper or accountant or CPA go through those bank statements and easily be able to see which things count for write-offs and which things don't, so just make it easy for everybody. All right, here's number 3. This is the best by far and my favorite tax advantage for investing in real estate and owning rental properties. It's cash out refinance. I have done 2 cash out refinances in the past 18 months, one for $880,000 and the other for $1.4 million. And I paid $0 in taxes, meaning I got checks from my business for $880,000 and $1.4 million, and I didn't pay a dime of taxes on that income that I got. Before I explain that a little bit better, the reason that I did not pay tax on that, because it's not considered income. When you're doing a refinance, you're pulling out debt out of the equity that you've created in your rental properties, and the fact that you're pulling out debt and you're adding it to the mortgage, debt is not taxable. If it was income, it would be taxable, but the fact that it's debt that I'm creating is not taxable. So I want to show you a simple example of cash out refinance so you can see what I mean.
Let's say you've been growing a rental portfolio over the past few years and done really well, and you own $10 million worth of real estate, meaning that's the value of the real estate that you own. That's awesome, but it's a newer portfolio for you, so you have a pretty high loan ratio on that, meaning you own $10 million, but you owe the banks $7 million. That gives you $3 million worth of equity. Most banks will go up to 80% loan to value, meaning they will give you a loan of up to 80% of what your rental portfolio or house or building is worth. So as you can see, simple math, we're only at 70%. So there's 10% that the bank potentially will give you in cash when you refinance. Now that $8 million or that 80% does create a new loan, but you get paid the difference. So let me explain that with this math. So your old loan is $7 million on that $10 million worth of real estate. However, the bank will give you a new loan of 80%, which is $8 million. So now you owe the bank $8 million. You owe that in the form of a mortgage, so your monthly payments went up a little bit. However, you're able to pull out the difference, and the bank will write you a cash check for that difference. It's like handing you cash. It's a cashier's check. I know it's like cash because I accidentally threw away cashier's check a few years ago for $100,000. And it's just like throwing away cash. The bank wasn't very happy. My private lender wasn't very happy. I had to actually write the bank a check for $2,000 to insure that money. So don't throw away cashier's check, side note, but just know that the bank will hand you a cashier's check for the difference. And if your rental portfolio is big enough, it can be a very big number that you get tax-free because it's debt and not income. Now, some people say, well, now you have an $8 million mortgage instead of $7 million mortgage. Yes, I have a little bit higher monthly payment. However, I'm able to create so much more with that $1 million of tax-free money than that little bit that my mortgage went up, because that mortgage is spread out over 25 or 30 years. I'd much rather have $1 million in cash now to go and grow and turn into a lot more and just have a little higher monthly payment, which my renters are paying anyway.
Making money is fun, whether you're doing it at a W-2 job or doing your own business or investing in real estate. But paying taxes isn't fun. So if you can utilize these strategies I talked about in this video and other great ones out there, you can limit the amount of taxes you're paying every year and put more money in your pocket. Hope you enjoyed this video. If you did, please hit that subscribe button. I'd really appreciate it. Also hit that notification bell. I like to go live a lot on YouTube here. And if you want to interact with me on a live, you want to get notified when I go live. See you on the next one.